We are looking at Sigma Lithium, ticker SGML, and the screen is just a sea of green. The stock is currently trading at $8 and it is up a staggering $1.94 or 31.96% on the day. An absolutely explosive move that has many traders, whether they're using a Robinhood stock trading app or a professional interactive brokers trading platform, scrambling to figure out what is going on. Now, when you see a move like this, especially in a beaten-down sector like lithium, the immediate expectation is simple: a buyout. The market has been treating Sigma Lithium as the last big, high-grade, pure-play asset in a for-sale window for over a year, so the assumption, the expectation, is that today's surge must be the long-awaited bid. Someone, maybe Codelco, maybe a major automaker, has finally put an offer on the table, and this is the market reacting to that news. But here's the reality. And this is what separates a quick trade from a real investment strategy. As of this moment, there is no press release. There is no SEC filing confirming a bid. This entire 31% surge is happening in a vacuum of official, concrete news. This isn't a fact. It's a fever. This is the market pricing in the rumor as if it were a certainty. And this is where things get incredibly dangerous or incredibly profitable. This move seems to be driven by a combination of factors that are far more complex than a simple headline. We are seeing a high-volume breakout, which is good, but it's also colliding with a stock that has a very high short interest. Fintel data recently put that short interest at over 17% of the float. That is a significant number of traders betting against this company. When a stock with that much negative sentiment starts to rip upwards, the short sellers are forced to buy back shares to cover their losses, which only throws gasoline on the fire. This has all the hallmarks of a vicious short squeeze, amplified by the ever-present, simmering M&A, mergers and acquisitions narrative that surrounds this name. Let's break down this recent action, because it's critical. This move didn't come from nowhere. The stock had been basing in the $5 to $6 range for weeks after a brutal downtrend from its highs. Just last week, the company reported its third quarter 2025 results. The numbers were interesting. They showed a big 69% quarter-over-quarter revenue increase and a 36% jump from the prior year. This was driven by better pricing and higher sales volumes. They also generated $24 million from final price settlements, which helped their cash position. But here's the catch. The mine, their flagship Grota do Cirilo project, was actually shut down for all of October to upgrade mining equipment. Production in Q3 was down 36% sequentially. So the revenue numbers looked good because of commercial strategy and timing, not because the mine was pumping out more material. The company expects mining to restart by the end of this month and ramp up in the first quarter of 2026. This is the kind of mixed signal report that a volatile stock thrives on. The bulls can point to revenue growth and cost-saving plans, while the bears can point to a complete production halt and a dangerously low cash balance of only $6.1 million as of September 30th, 2025. This context is everything. Today's 31% leap is not happening because the lithium market itself is on fire. In fact, it's the opposite. Lithium carbonate and hydroxide prices, while showing some very recent signs of bottoming, are still in a deep slump, down more than 80% from their 2022 peaks. The spot price for spodumene concentrate, which is what Sigma produces, is hovering around $1,000 to $1,100 per ton. That is a world away from the $8,000 plus per ton prices seen at the market top. This isn't NVIDIA stock riding the clear, undeniable wave of artificial intelligence. This isn't Apple stock sitting on a mountain of cash and services revenue. This is a junior mining company trying to execute a massive project in Brazil, tied to a commodity that has been in a bear market. The divergence between the underlying commodity price and this stock's explosion today is the central tension. This move is purely about the asset itself, not the product it sells, at least not at today's prices. So what does Sigma Lithium actually do? This is the part that often gets lost in the M&A hype. The company owns and is operating the Grota do Cirilo project in Minas Gerais, Brazil. This is widely considered to be a Tier 1 asset. It's a hard rock lithium deposit that is known for its high purity 000 green lithium. This means it's produced with zero hazardous chemicals, zero hazardous tailings, and 100% renewable power. In an online investment world increasingly focused on ESG, environmental, social, and governance factors, this is a massive selling point, especially to Western automakers who want to build supply chains that are not dependent on China and are verifiably clean. Phase 1 of the project is operational and has been shipping spodumene concentrate. The company's recent earnings call laid out its plans to expand, aiming for 520,000 tons per year by the end of 2026 and eventually even more. This is a real producing asset, not just a drill hole on a map. This is why it's so attractive. It's one of the few large-scale, high-grade, independent lithium projects available in a friendly jurisdiction. It's the crown jewel, and everyone knows it. The company's past performance tells this story perfectly. If you were a self-investing individual who bought this stock in 2021 and held it through 2022, you saw astronomical gains as the Tesla stock and EV story went parabolic, dragging all lithium producers with it. But if you bought at the peak, you've experienced a gut-wrenching 80 to 90% decline. This is the brutal nature of commodity stocks. Many long-term holders in Fidelity mutual funds or Fidelity ETFs that track the materials sector have been whipsawed by this. The volatility here is not for the faint of heart. This is why many active traders use platforms like the Fidelity mobile app or the SoFi trading platform to try and time these swings, while more passive investors might just get exposure through a broader, intelligent portfolio that allocates a small percentage to the entire battery metals theme. Now let's turn to the future, which is where the real speculation lies. There are two distinct paths forward for Sigma, and today's 31% move is the market betting heavily on path number 1. Path 1 is the buyout. This is the expectation. The narrative has been that Chile's state-owned Codelco wants to become a lithium giant and could buy Sigma to get a foothold in Brazil. There have been rumors of interest from Chinese firms like CATL, which would likely face political hurdles. And, of course, the ever-present mystery automaker who wants to secure its own supply, just as Tesla has sought to do. The problem has always been price. Sigma's management, led by CEO Ana Cabral, has held a very high valuation on the company, and suitors have reportedly balked at the price tag, especially as lithium prices collapsed. Today's move is a signal that someone might be willing to pay up, or at least that the market thinks someone is. The question is, what's the real price? Is it $10 per share? $15? $20? The analyst consensus is all over the map, with some targets as low as $9.50 and others, from more bullish houses, stretching much higher. Comment below what you think a fair buyout price for Sigma Lithium is, or if you think they'll go it alone. Path 2 is the go-it-alone reality. This is what happens if no bid materializes. If today's 31% surge is just a short squeeze on a day with no news, the stock could easily give all 31% back and then some. In this scenario, Sigma becomes a pure execution story. It has to successfully restart and ramp up mining operations. It has to fund and build its Phase 2 and 3 expansions, which will require a lot of capital. And it has to do all of this while surviving in a low-price lithium environment. Their recent Q3 report with only $6.1 million in cash shows just how tight their finances are. They are leaning on off-take agreements and prepayments to fund operations. This is a high-wire act. If they succeed, they will be a massive low-cost producer, and the stock will be worth a fortune when the lithium market turns. But